one tip I give is to really think of the income statement as your boss. It is the most objective boss out there. The numbers are either getting better every year or they're not getting better. That's why I really like holding yourself accountable to the income statement.
Welcome to Solo to CEO. We're sitting here with Jon Morris. Jon, tell me a bit about what you do.
Thanks so much for having me on here. I've actually been an entrepreneur for pretty much the majority of my adult career, mostly in the marketing agency space. My last agency, I grew, going exactly from your title, from solopreneur to CEO, from just me to about 250 people before selling the company in 2020. And today, I help professional service companies really focus their time to increase cash, profit, and revenue by teaching them a framework on how they should spend their time and their money more efficiently and more effectively.
Awesome. So I want to get into that. I think that's the backbone of a business. I want to first understand what made you make that transition.
So why did I sell the company, or why did I start this business?
I'm sensing there are two different answers. So let's start with why you sold the company.
Yeah, so I sold the company. My favorite day of the year is the first business day of the year. And I call that game day. And I would generally spend about 6 months planning for game day. And in 2019, I put my plan together for 2020. And I think it was a great plan, but it just was the same plan as 2019. And it was the first time that I just was not excited for game day. And so that was the first sign that I was ready. The second thing is my original exit strategy for Rise Interactive, my last agency, was that I was going to die one day. And I had, basically a 20-year time frame to run the business, and every year I added another year, so it always stayed at 20 years. But then when you get married and you have a family and all of a sudden all of your wealth gets tied up in one asset, diversification became a much more important strategy for me. So I would say the combination of not excited for game day and wanting to diversify was kind of the decision that it was time to move on. In terms of why I created this business, I stepped down as the CEO of Rise Interactive on April 1st of 2020. Now, one of my favorite days is April Fool's Day, and I did a lot of April Fool's jokes on my employees, and I think they were getting even with me by stepping down at the very beginning of a pandemic. And I had 3 daughters at the time, 6, 8, and 10 in age. The world is shut down, and I had to do something with my time. So I decided to start this business much sooner than I originally intended on doing so. And when I was at Rise, I had a business coach. And for the last few years, I would meet with this coach every 3 months at a minimum. And he would say to me, the insights you have is a business within itself. So when I'm sitting there trying to figure out what am I going to spend time on, I was like, you know what? I recognize that there are metrics that professional service companies don't understand that they should be focused on. And so they spend their time and energy in the wrong areas, and that I believe that I can help share those insights. And so, that's kind of how it all came to be.
So give me a brief rundown on the 2 different companies that you're currently running.
Yeah, so I have EngineBI and I have Fiscal Advocate. Before I even start that, let me just explain what I'm trying to help people do and then how the 2 companies tie together. I believe that there are only 3 metrics that matter. So I was in a pitch about 8 months ago, and I was talking to an agency, and he's like, I'm pretty sophisticated. I track 315 KPIs on a daily basis. And my feeling is that if you're tracking 315 KPIs, you're tracking nothing. I want you to do the opposite. I want you to track the fewest number of KPIs possible. So the only KPIs that I believe that matter is your cash relative to your monthly overhead, your profit margin, and your year-over-year revenue growth. And so we created something called a CPR score, which is, if you think about a credit score for an individual, this is a credit score for a professional service company. And based on their CPR score, it tells you how well or how poorly they're doing. So every single thing that we are focused on is helping companies increase their CPR score. Now, I've then created a framework called the BASE framework. BASE is an acronym for business planning, alignment, scorecard, and execution. And there are 14 rituals of how you should spend your time and money that will help you increase your CPR score. Now, when it comes to rituals, every single business owner has rituals. It might be they check their emails in the morning. They might have certain ways of analyzing their clients, whatever those rituals are. But I don't believe all rituals are equal. And so I'll give you an example. One of the rituals that we teach people is how to have a quarterly sales and marketing plan. Another ritual we teach people is how to do budgeting and forecasting. And so if you follow those 14 rituals, you should increase your CPR score. So now to answer your question of what does EngineBI do and what does Fiscal Advocate do, EngineBI is basically helping you implement that BASE framework. So there is a mastermind program that teaches you the BASE framework. There is one-on-one coaching where you have BASE framework implementers. And then most importantly, there is a technology solution that is integrating those 14 rituals so that you have the tools to actually implement the program. Fiscal Advocate is basically an outsourced finance department for professional service companies. Now, the reason why that is important is a lot of the components of the BASE framework is learning how to take a data-driven approach to running your agency, and it's crucial to have a world-class finance department in order to do that. So, as I mentioned before, one of the rituals is budgeting and forecasting. Another ritual, which might sound strange, is to have a really solid method for closing your books on a monthly basis. Now, the reason why that's important is because we want you to have really good month-end analysis that allows you to make decisions on your cash profit and your revenue. And if you don't close the books properly, then you're not going to be able to get to that analysis. And so Fiscal Advocate will really help you implement the BASE framework from the financial and data-driven perspective.
But we actually do that by default because of the tax laws of where I'm at, right? We have two companies in two different countries, and the country in Israel, you actually have to do, if you're a certain size and over, you actually have to do monthly bookkeeping. So I never even thought of it as something that I'd have to discipline myself to do because I'm just used to it. But hearing that perspective.
But then the question is the month-end close, like you're doing it because of legal reasons. I want you to be doing it for month-end analysis reasons. So I want you to be able to answer questions like, what % of your revenue do you spend on sales and marketing? A typical professional service company spends 8% of their revenue on sales and marketing. And if you're spending less than that, you're at a competitive disadvantage. And so how do you spend more as a % of revenue on sales and marketing? And there's all sorts of different methods that we teach people how to do that so that they can scale and grow.
Nice. Yeah. Well, in our case, we do monthly bookkeeping actually for, I call it, there's tax bookkeeping versus biz dev like business development bookkeeping. So we do them both together, and then we kind of, we have an interesting setup that I did on Google Sheets. But I'm interested in hearing more about your CPR. What's it called? EngineBI. I actually checked it out. It looks pretty cool. I love the layout, like the CPR. And I also love the what's it called? The kind of the play on words, where it's not just about cash, profit, and revenue. It's not just an acronym for cash, profit, revenue. It's also CPR.
Exactly. It's a play on
what's going to keep your business alive.
So it was done by design, where the higher your CPR score is, the higher your health is, and also look, if for your audience listening here, if you're in business, if every year you're increasing your year-over-year revenue growth, you're increasing your profits, you're increasing your cash, well, then you're increasing your wealth. You're creating more job opportunities for your employees. You're creating more responsibility for your employees. And so these three numbers really drive everything. And everyone's challenged me. People come to me and it's like, well, what about like client retention or employee retention? And I was like, well, if you think about client retention, that's going to impact your year-over-year revenue growth. So if you have a really low retention rate, you're going to have a really hard time in terms of year-over-year revenue. So the idea is that once you have these three numbers, then you go to the next numbers underneath it. So I'll give you an example with revenue. There's only three numbers that matter. It's how do you do in terms of winning new business, your renewal rate, and upsells. And then if you take new business, there's only four numbers that matter. Your number of at-bats, your win rate, your average order value, and your velocity to win deals. And so in each one of these, there's a very few numbers that you need to know to look at what you need to do to drive and improve performance.
I think part of why it's so important what you do and why you actually left the marketing space to jump into this is, I believe, is because it's one of the most overlooked things in business, in my opinion. People are so focused on client acquisition and production and all these things that are crucial. They're so important, which is why everyone focuses on it. But they forget kind of like what I called before the backbone, which is to make intentional moves, to be intentional about your financial decisions and not just do things based on, this is what we're used to, or based on, reactive decisions.
I agree more. Like one of the things I tell people is it can't be a goal unless you put budget against it. So I'll give you an example. I had a call with a company yesterday. They're a $2.5 million agency. They want to go to $5 million. They spent $600 on sales and marketing over the last 4 months of this year. And so I basically explained to them, I was like, look, if you want to go from $2.5 million to $5 million, you're going to have to invest in sales and marketing. Like you're telling me that it's not really important to you because you're not investing in growth. And so what we want to do is we want to help you understand that if something's important to you, then we need to allocate budget to it. And then we got to measure the impact. There's two numbers when it comes to sales and marketing that I care about. The first is what percent of your revenue do you spend on sales and marketing? And then the second one is how effective is that spent? Because just because you spend money doesn't mean you spend it well. And so you need to constantly optimize it to make sure you're getting higher output out of the money that you actually do spend.
Absolutely. So can we go through each of these three letters, the C, the P, and the R, right? So just to go through each one of them and tell me why you chose cash flow over all the other metrics, why you chose profit over all the other metrics, and revenue.
Sure. So the first one, as I said, cash relative to monthly overhead. If you have a lot of cash, you get to do really fun, cool things. I'll give you a really good extreme example. Microsoft bought LinkedIn for $26.2 billion in an all-cash deal. So if you want to scale and grow your business, building a war chest of cash is going to allow you to have M&A as an opportunity and another method to grow your business. The second thing is you never know when the next COVID is going to hit. And so if you don't build a reserve of cash, you're not going to have a rainy day fund. So, that's the first component. On the profit side, if you're in the professional service space, there are very typical expected numbers of what you're supposed to achieve. So if you are doing really well, you generally have a 20% EBITDA. So meaning if your revenue is $10 million, you have $2 million in profit. If your revenue is $1 million, you have, $200,000 in profit. And in each specific area, there's a certain amount of money that you should be spending to make sure that you stay within the benchmarks. And so from a profitability standpoint, I believe it's really important for, if you want to be world-class, that you should be spending the right amount in each area, and you should determine where do you want to spend more and where do you want to spend less. But all of us go into business. Like, no one has ever been like, you know what, I'm going to go start my agency and I really want it to be a not-for-profit, meaning that I'm not going to make any money. They generally think that I can do a really cool solution and provide some value to my clients, but I want to make sure I get compensated fairly and appropriately for that. And so profitability is, a big part of why people are in business and the health of the organization. And then lastly, year-over-year revenue growth. I believe it is one of the greatest measurements of a CEO. And, if you think about going up against multiple competitors who do the exact same thing that you do, that you want to make sure that, you want to make sure that you're performing well and that your wealth is increasing. The greatest way that you could get multiple expansion. So like when you sell, you generally sell as a multiple of EBITDA. EBITDA is a fancy word for profit. And you get a multiple of that, that you want to make sure that you're expanding that multiple as much as you possibly can. So year-over-year revenue growth is, a big key to that success.
So what are some metrics that you see people tracking in place of this CPR, right? So maybe someone's not tracking profit, but they're tracking something else. And if you've seen this, what are people tracking that they shouldn't be, or they shouldn't be prioritizing, and why?
So I think it's that they're tracking like so many different metrics that it's hard to really make decisions. So first of all, I'm a big believer that most of the important things that you track are on a monthly basis or quarterly basis. That there are some weekly numbers that you can measure, but the cadence is just too frequent that you can't like make decisions every 7 days that you're going to go in a different direction. So, but you might be looking at, like on a new business standpoint, let's just say, number of visitors to your website, number of visitors that went to a specific page to your website, your retention rate of employees, the number of resumes you receive from specific employees, for new hires that you're looking to do. I mean, the list could go on and on of like what you could be looking at and what you could be measuring. The question is, what does it drive to? Does it drive to cash? Does it drive to profit? Or does it drive to revenue? And if it doesn't, don't get me wrong. Like I used to, like when we were at Rise, oftentimes we were growing like a weed. And we had to hire people really aggressively. I would require a report of every stage of an employee that we were trying to hire. So like, how many resumes did we receive? How many did we screen? How many did we invite for a phone interview? How many interviews were conducted? How many offers went out? And I found by putting that daily pressure on the team, like our velocity to hire people quickly, like improved. But that was necessary because I had a revenue that I needed to support. And if I didn't get the employees, I wasn't going to be able to service those customers. And so it's not that there aren't metrics that you want to follow that aren't cash profit or revenue. But I would say that that's a direct, connection to revenue, because otherwise I'm going to have churn. And I'm going to burn out my team. And so that was a situation where, we had to hire a substantial amount of people at a really quick rate.
Right. Well, there will always be exceptions. There will always be temporary situations where you need to track something else. But yeah, we see the CPR as the heart. The heart pretty much runs the body.
And if you just think about yourself as a CEO, like you talked about, this is like from solopreneur to CEO. Like as a CEO, when people are looking at how have you done as a CEO, they're going to really measure you based on those three metrics. I can't think of any other metric, that they're going to measure you on. Maybe the market cap of your business, but those are going to be driven by those three numbers.
So, what are some mistakes that you feel you may have made over the course of your journey? Because you've had a fairly large business journey. What are some mistakes that you made that you wish you would have known what you're about to tell us sooner?
For many, many years, I did not focus on cash at all. And I focused very little on profit. I really focused on year-over-year revenue growth. If I could have gone back in time, I probably would have focused on all three. We did not really grow from an M&A standpoint. We grow from an organic revenue standpoint. And I think I missed out on some opportunities there to scale and grow faster. Just to give you a good example, in 2016, I did a minority round, and I raised a bunch of money. And it was really interesting. There was a bunch of companies that started right around the same time as me, And we kind of all followed the same trajectory. We all raised minority rounds right around the same point. We all exited the business right around the same point. And when they raised money, they used it to go buy other companies and expand their revenue through acquisition. We chose to invest in technology and continue to try and grow organically. And what I found was that they grew at a faster rate than I grew by choosing that strategy. And so it's not just having the cash, it's what do you do with that cash? And M&A is a great way to add scale. You know, if you're a $10 million business and you want to go to $15 million, buying $5 million worth of revenue versus trying to have a new business team that generates $5 million of revenue, it might take a lot longer to do it that way.
How so?
I mean, it all depends on how much you generate in new business per year. When I was at Rise, we would typically do about $6 million in incremental increases in revenue on a year-over-year basis. So I went from 13 to 19, 19 to 24, 24 to 30, 30 to 37, and that was around when I exited. But you can see it was, $5 to $7 million each single year. Although scaling and growing nicely and adding, millions of dollars of revenue, I was never able to break through and start adding $20 million in revenue or $30 million in revenue on an annual basis. So having cash, I could have chosen, I'm going to go do a $20 million acquisition of a company and grow that way, as opposed to trying to do it over, let's just say, 3 to 4 years through the new business standpoint.
What would you say to someone that wants to, that's doing their bookkeeping for tax purposes only, and they're listening to this and they want to just, get their feet wet with, tracking their expenditures or tracking their business?
So one of the rituals that I recommend is month-end analysis. Okay, so you have month-end close, but then you have month-end analysis. And the way you organize your data is going to help you answer questions. So, for example, one of the questions I ask you is, what % of your revenue do you spend on sales and marketing? Another question I ask people is, what is your gross margin? 95% of the companies I talk to have no idea what their gross margin is, how to calculate it. Because they're service-based companies, their payroll is generally in one line item, just bundled together. You have to unbundle it to move it to the proper areas. And so you can gain a lot of insights by being able to understand what's your overall gross margin, and then you want to dig deeper of what's your gross margin by line of business, what's your gross margin by team member, what's your gross margin by client. That allows you to start making profit-related decisions where you might have a bunch of clients that are just dogs and you're losing money on.
How would you determine your gross margin by team member or by client?
Okay, let's just start with what your gross margin is overall. So when you take your revenue minus what I call your cost of service, you get your gross profit. So your cost of service refers to any employees that relate to doing client work, any freelancers, any technology that's related to client work, any travel and entertainment related to client work that you don't get reimbursed on, any client gifts, or any other related client-related expense. And so if you are looking at your income statement and you have a line item that says payroll, the first thing you want to do is separate that out based on people who do client work and people who don't do client work. Then from there, once you know your gross profit, your gross margin is simply your gross profit divided by revenue. So let's just say you have $1 million in revenue and you spent $600,000 on your cost of service. 1 million minus 600,000 is 400,000. Your gross margin would be 40%. Now, just some rule of thumb to follow. We typically want a professional service company to have a gross margin between 50 and 60%. If it is above 60%, I want to make sure you're not burning out your team or that you're not under-delivering for your customers, because that might lead to churn. If it's between 40 and 50%, I find that you're generally choosing between being profitable or investing in your business, but it's hard to do both. If you're at 50 to 60%, you can do both. If you're under 40%, you're most likely losing money. So before we even get into by line of business, now we're just getting into the heart of what matters, which is what is your gross margin overall? Now, the next thing would be you can start assigning individuals to categories they belong into. So let's just say you have an employee, and let's just say you sell search engine optimization and paid search, which are two services that relate to marketing, digital marketing. Anyone that is on the search engine optimization team, you're going to put in the search engine optimization cost. And then you got to break your revenue out as well. So what is your revenue by line of business? So now we could start saying, imagine you have a 40% gross margin. You might find that you have a 53% gross margin for paid search, but you have a 35% gross margin for SEO. So you know your problem is SEO, and that's what you have to fix. And so that's how, like, getting your data organized and more granular allows you to understand where to make moves and what the insights are.
That's interesting, actually. It's just, I talk about this actually, how important it is to measure things by line of business, because for years, for a really long time, we were doing personal events, right? Like weddings, and specifically live streams. And our angle was that we would, no pun intended, actually, our angle was that we would come with multiple cameramen and get multiple angles and stream all that live, right? So we'd switch cameras like in the middle of the wedding, and we'd be able to like be like all over the place at once. So you were actually even better off by not being there and watching it live because you get to be everywhere. And it was super cool. And we were also doing, promo videos and corporate work. And then when I started writing things down, which is what is about, year 2021, the end of year 2020, I started to see a pattern, and I started to realize that our corporate work was funding our, personal client work. Yeah. And I was like, wait, hold on a second. If we just stop that cold turkey, then we'll make much more money. Like, it was just so simple once you see the numbers.
And so that's a very strategic question. So the question is, do you want to change your pricing, figure out how to offer the same quality of service for a lower cost structure, or lower the quality of service, or no longer provide that service? So those are kind of the key questions that you have to ask to determine, what's going on. And, because I see that all the time. A lot of times people will have great gross margin, but it's because one business line is subsidizing another business line.
What are some mistakes that you frequently see businesses make, whether it's your new clients when you come into their business, like what you see them doing, or just people in general?
So the first thing that we see all the time is that, the revenue won't be broken out by line of business. So you'll just see, like, when you look at the income statement, it just says sales. So the problem is then you don't have any trend analysis. You don't know if one group is doing better than another group. You don't know if there's revenue from a line of business that's in the decline. So that's the first mistake I see. The second mistake I see is they don't calculate gross margin or gross profit at all. They don't understand it. They don't know why it's important. The third mistake is when you are looking at your expenses, all of your expenses, I don't care if you're a one-person company or a 1,200-person company, all of your expenses can be broken up into 4 categories: sales and marketing, operations and finance, your executive team, and R&D. And when I say operations and finance, I specifically mean HR, legal, corporate IT, general administrative expenses, and finance. And so when I look at the expenses, it has a long laundry list of just different things that you're spending money on. It's kind of like if you went to a hardware store and there was a big bucket of like nuts, bolts, and screws, but they weren't like categorized or organized in any way. And so, what I want to be able to do is I don't want you to have to do math in your head. I want you to be able to basically say, like, this is what I spend. So you get 15% of your revenue to spend on operations and finance. You get 7% of your revenue to spend on your executive team. You get 8% of your revenue to spend on sales and marketing. And so it's like by knowing these numbers and organizing your data well, you can make really intelligent decisions. 99% of the companies I meet with do not have enough cash. Even if they're widely profitable, the owners are taking all the cash out of the business. So that's another big mistake that I work on teaching people is we got to grow your cash so that we can build a weapon that allows you to grow through M&A.
So this is really interesting because it's actually very, very relevant to me because I have one category called sales, or it's called marketing, but it's marketing, advertising, all that. So which leads me to a question. It's how do you start separating everything? Meaning how many categories do you have going on there? You got to have like thousands. So
typically, companies have between 3 and 10 lines of business. I'd probably say the average is 5. Let's just use yourself as an example. You talked about your corporate work. You talked about your wedding work.
Wedding is history.
What? Yeah. Weddings are history. But,
the wedding work is history.
So then we would say, is there different types of work that you're doing for different groups?
Well, we service like organizations, like non-for-profits, as well as, smaller companies and medium-sized companies. So we have like different products for each.
So we would go through all those different products and we'd really look at like what services you were offering. And then you come up with, these are your kind of core services that you really sell. Then we look at your invoicing. If I don't know what you use for invoice or for accounting, but let's just say you're using QuickBooks, which is what a lot of people in the United States use. They have the ability to invoice somebody in a bundle so that they won't see it broken out, but you can break it out behind the scenes. So we want to talk about, do you care if are you transparent with your client on what you're invoicing? Or do you want it to be a bundle where they can't be like, well, why are you charging me so much for this one thing? So the last thing I want to do is by giving you analytics is have you have tough conversations with your clients. But there's generally a good facilitation and exercise that you have to think about what your lines of business are. A lot of times that's challenging for people and it takes a little time for them to think about.
Yeah, it's a good question. Is each product a different line of business?
Generally, yes. I mean, it all depends. Like, I'll give you an example. I had at Rise 3 major lines of business: media, analytics, and creative. Actually 4, and web development. But then under media, I had multiple sublines of business. So we had search, we had programmatic, we had affiliate. Then under search, I had more lines of business. I had paid search, SEO, and marketplaces. And so you can have core service lines, and then you can have sub-service lines underneath each one of those as well. And generally that happens as you get bigger and you scale.
Okay, I have a question actually. This is probably more relevant to me than anyone else on this podcast. But if you were tracking things in multiple currencies, what kind of software would you use to track it?
I don't know the answer to that.
A business that runs on multiple currencies.
I don't know the answer to that question. I can tell you in EngineBI, we support multiple currencies, but I can't tell you in terms of like your accounting software, if you have pesos, does it convert it to dollars? Or if you have, I forget what the currency is in Israel. Shekels.
Shekels.
What? Yeah. And can you convert that to dollars? So generally, accounting platforms should be able to convert that, but I would pick one currency as your primary currency to evaluate everything.
Awesome. I'm narrowing down my questions now because I see we only have a couple minutes left. What do you think about using Google Sheets for as just general biz dev bookkeeping?
So for biz dev, for actually generating new customers, or for your finances?
To measure your meaning bookkeeping that's not for tax, specifically for taxes.
Look, I would say that most, let me just explain the finance department real quickly. There are 4 groups to a finance department. There is tax. There is what I'll call capital markets, which is securing lines of credit with the bank or raising capital. There is accounting, and accounting is generally invoicing, AR, AP, payroll, as well as month-end close, so closing the books. And then there's a group called FP&A. FP&A stands for financial planning and analysis. Generally, if you have an analyst, they will start with Google Sheets or Microsoft Excel. That's the world they know. That's the world that they're comfortable in. At some point, as you scale, you're going to need systems that will add more efficiency. So I'll give an example. EngineBI connects with accounting platforms and pulls in data automatically. So you might have to do that manually if you're using Google Sheets or Microsoft Excel. You might want to give people different permissions or rights. So imagine you have an account team and you want them to update the revenue numbers, but you don't want them to see the CEO's salary. If you're using a Google Sheets, you have to create multiple Google Sheets in order to manage something like that. So there's nothing wrong with it. It's just at some point you're going to outgrow it.
Gotcha. My second to last question is, what's one tip you'd give based on everything you've learned over the last number of years that you've been in business? What's one tip you'd give to the CEO of, or an entrepreneur of any service business?
So the one tip I give is to really think of the income statement as your boss. And it is the most objective boss out there. The numbers are either getting better every year or they're not getting better. And so you can really hold yourself accountable to the performance of that. The other one, which I'll give as a second tip, is the only thing, and I heard this from my professor at business school, the only thing worse than going bankrupt is being a business of the living dead, which is you make just enough money to never make any money. And so that's why I really like holding yourself accountable to the income statement.
Awesome. I love it. Now, if someone were watching this and they wanted to get in touch with you or your team or whatever it is for either of the companies that we've discussed, what would be the best way?
So best way is to connect with me on LinkedIn. I post regularly. I connect with everybody. And, you can definitely message me. My email is jon@enginebi.net. And so you can also email me at any time. And you can also go to either fiscaladvocate.com or enginebi.net to learn more about either company.
Amazing. And once again, thank you very much for coming on.
Thank you so much for having me.
We really enjoyed it.